The key headline here, of course, with Uber is next quarter, adjusted EBITDA loss now below $100 million, estimated loss of $95.4 million. Not quite getting that adjusted EBITDA profitability the way we saw with Lyft yesterday, guiding us forward to a hopeful positive number by the fourth quarter. Let's do it all with Mandeep Singh, our senior technology analyst for Bloomberg Intelligence. And you've been nailing this, that Lyft was the pure play on the reopening. Uber was supposed to benefit from the diversification, but perhaps showing that today some of that diversification isn't paying off.
Exactly. I think what you're seeing with Uber is they are trying to, build their delivery business, and it's an $8 billion revenue run rate business. Guess what? It's still not profitable. You still have got a fragmented market. They are pretty much subsidizing all the other businesses like delivery, like freight from ride sharing. And they've been doing it, but investors don't see a path to profitability for Uber at this point.
So, the company talked a lot about this idea that they had to pay their drivers more or offer a little bit more incentives to get the drivers back here. Are these sort of temporary costs? Did they get to a stage where maybe they can pull back on some of that and maybe sort of right-size the profitability picture? Well,
the good thing is on the ride-sharing side, it's a duopoly. So think of, airlines or FedEx or UPS. Mm-hmm. Eventually, you're going to get to that stage where, Uber and Lyft can both have their market share and they'll have, pricing rationalization. And we have seen the EBITDA margins on the ride-sharing side are it can be double-digit EBITDA margins. On the food delivery side, on the other hand,
can I push back on one thing, though, on the duopoly, though? Because I've heard this before, and then it doesn't factor in taxi cabs, it doesn't factor in the bus or the train and other forms of public transit.
Well, so we know consumers like that app experience better, and there is definitely, a step up in terms of people preferring to do their business expenses, using an Uber ride as opposed to taking a taxi. Yeah. So it's still a better experience. On the food delivery and grocery delivery side, you've got 6 or 7 players all trying to do the same thing. There are no switching costs. And at the end of the day, consumer doesn't care. They will go towards the cheapest option. So there is no loyalty. And Uber continues to pour money in that. Yeah. And that is, I think, what is hurting them, especially on the EBITDA side.
Yeah, and grocery delivery as well, they're into. And that's fiercely hot and competitive at the moment. They just go from battleground to battleground. Are people going to, at some point, want them to still be investing great chunks of change in these sorts of areas or not?
Well, they just doubled down on the freight business with this acquisition of Transplace. So their at least playbook is, we want to be the scale player in each of these markets. We'll keep, acquiring or partnering with companies. And at the end, we will be profitable. It's just the end seems to be far out. It doesn't seem to be, maybe they get to EBITDA profitability by the end of the year, but they can't sustain it because delivery is inherently a low-margin business. You can't make it a higher-margin business unless there are 2 players left.